Okay, I think we're ready to go. Good afternoon, everyone, and welcome back to our third annual Cross-Institutional Lending Conference. My name is Richard Dusome, and I'll be your host for this session. I'm a senior counsel at Gowling WLG, have practiced for over 30 years in our lending group, currently working out of our Hamilton office. My practice consists primarily of secured transactions, financing opinions, and third-party or intercreditor arrangements. If you're just joining us now, please note that we are in what we call stage mode, which means that your camera and your mic will not be operational at this point. That will happen later during our networking session. I encourage you to participate, however, in today's session by asking questions of our presenters and putting those questions in our Q&A feature. We will turn to those at the end of the speaking portion and answer as many questions as we can. Our topic for this session is financing share and asset purchase transactions. I am joined today by Sasha Babak, a partner of our corporate group in the Hamilton office, and by Travis Evans, a senior associate in our corporate group, also in the Hamilton office. Sasha acts for private sector clients of all sizes with an emphasis on mergers and acquisitions, corporate organization and restructuring, private equity, financing, and commercial agreement reviews. He also acts for a number of public and quasi-public institutions, including universities and school boards, advising those clients on matters involving both traditional corporate commercial issues and unique sector-specific issues. Travis is a senior associate working primarily in the firm's corporate and commercial practice group, advising on all manner of corporate transactions, including share and asset purchase transactions. Travis also routinely assists with bilateral and syndicated commercial financing transactions. Some of you will have already been involved in financing a share or asset acquisition, either by one of your existing customers looking to expand its operations, or by a new customer seeking to get a fast start into a new business. Others will soon come across one of these transactions as your career progresses. Purchase agreements can be a few pages or hundreds of pages, and may be between arm's-length entities or affiliated entities. Sasha and Travis are going to guide us through some of the key aspects of share and asset purchase transactions lenders need to understand prior to financing an acquisition transaction. This will be an open session to maximize the opportunity to ask questions. Sasha and Travis are going to first briefly review at a high level some important differences between share purchase and asset purchase transactions, and examine some of the standard due diligence lenders will want to conduct. Then we will open things up for questions about things you've already encountered coming across your desk and trends we are seeing. So without further ado, I'll turn it over to Sasha and Travis.
Thank you, Richard. Good afternoon, everybody, and thank you for joining us today. As Richard mentioned, this presentation is really going to focus on the two most common mechanisms used to structure M&A transactions of private businesses in Canada, namely share purchase transactions and asset purchase transactions. Now, most of what we present today is probably not going to be new information to most of you, and sometimes it is helpful, however, to look at a topic like this from a first principles perspective and just review the basics. We have purposely planned to keep our presentation to kind of less than maybe 35, 40 minutes to allow time for Q&A. The one thing I do also have to note, we will be touching on some tax-related matters today, but we are not tax lawyers. While we certainly have a working knowledge of the tax implications of these types of transactions, and we can speak to them generally. When engaged on transactions, we rely on our tax group and our clients' accounting advisors. So apologies in advance if we are unable to answer any complex tax questions that you may have. However, we are happy to receive the questions and follow up with you at a later date. I also do apologize in advance for the inclusion of some cheesy and sometimes obscure song quotes in our slideshow. I will say if anybody can name all 5 of them, and the first person to email Mateus with all 5 song titles, he will send you a Gowlings t-shirt at some point in time. So let's do that. So next slide. So jumping into it, really, what is the difference between an asset purchase and a share purchase? And I think to put it in the simplest terms possible, an asset deal is a purchaser buying a business, while a share deal is a purchaser buying a corporation that owns a business. Next slide. In a share purchase transaction, the buyer purchases the issued and outstanding shares of a target corporation from its shareholders. Just for simplicity's sake, we're going to look at transactions focused on 100% acquisitions. We're not really going to delve into issues where a seller remains involved in the business of the corporation. Now, it is important to appreciate that the purchase price payable is not determinative of the complexity of the deal. So you should never fall into the trap of thinking, well, the purchase price is $100,000, so this purchase agreement and all the closing documents need to be kept simple. It's never that easy. And as Richard said, there can be two-page deals, there could be 100-page deals. The complexity is not tied to the actual purchase price ascribed to the shares. Now, a key component for any share deal is the scope of the reps and warranties that are obtained by a purchaser from a seller. Because the purchaser inherits all the company's liability along with its asset, it mitigates risk related to unknown or unforeseeable liability through the reps, warranties, and corresponding indemnities that are customarily included in the agreements. While a deep dive into the reps and warranties is beyond the scope of this presentation, Travis will touch on this a bit more later, but at a very high level, there are two key categories to consider. First, a purchaser requires representations and warranties related to the shares themselves. To put it simply, you will need to ensure that you have proper reps and warranties that ensure that title to the shares is being conveyed without encumbrances. Second, a purchaser is going to require reps and warranties relating to the corporation and its business. Now, these are far more fulsome. So from the purchaser's perspective, the reps and warranties need to be detailed, fulsome, and unambiguous so as to ensure that in the event of a misrepresentation, it has proper recourse against the seller. From a seller's perspective, on the other hand, the reps and warranties are also a mechanism by which a seller is able to provide full disclosure regarding the business and in turn is generally relieved from any liability related thereto to the extent it has been disclosed to the purchaser and not otherwise assumed by the seller as part of the deal. Next slide. So an asset deal, on the other hand, involves the negotiated purchase of the assets, and in most cases, assumption of certain liabilities of a company without actually acquiring the entity that owns them. So a key component of an asset purchase agreement is identifying what the purchased assets are, what the assumed liabilities are, and what the excluded liabilities are. With purchased assets, you need to ensure at a high level that the purchaser is acquiring all of the assets that are necessary to actually run the business. These commonly include things like inventory, whether it's finished goods or raw material, prepaid expenses, machinery and equipment, leased equipment and vehicles, leased premises and leasehold improvements, contracts related to the business, including customer contracts, supplier contracts, or other like agreements, business records, including customer lists and information, proprietary technology and IP, and goodwill, including the business name. Now, depending on the nature of the business, purchased assets might also include items such as license or distribution rights relating to a business granted by a third party, or even regulatory licenses if they're required by any governmental or regulatory authority. The purchased assets also may or may not include cash and bank balances and accounts receivable, but even if excluded, mechanisms are usually going to be included in the agreement whereby the cash balances are stripped prior to closing and whereby the buyer is going to undertake for some period of time following closing to help collect the outstanding accounts receivable for the period prior to closing. But finally, if a transaction involves real property, it certainly needs to be addressed. However, I'd say more often than not, real property is owned by separate holding companies and involves a contemporaneous purchase and sale by separate agreement and won't necessarily be included within the share purchase or the asset purchase agreement itself, or the share agreement, frankly. But it will close contemporaneously, and there are usually kind of cross default provisions and ties between the agreements. The description of assets in an asset purchase agreement is going to be unique to each deal, but as noted earlier, the main goal is to ensure that you have not failed to identify any material assets that are necessary to actually operate the business. With regard to assumed liabilities, these tend to be limited for asset deals, but customarily include things like trade accounts payable and accrued liabilities to trade creditors incurred in the ordinary course, and liabilities and obligations of the vendor accruing on or after the closing date under assumed contracts. And while the agreement will normally stipulate that only assumed liabilities are being assumed by the purchaser, Out of abundance of caution, it is customary to also expressly identify various excluded liabilities on a non-exhaustive basis, which normally include liabilities such as indebtedness of the vendor other than as expressly assumed, warranty or product return claims for the period prior to closing, taxes payable by the vendor for the period prior to closing, and any amounts payable to employees while under the employ of the vendor. Noting that last point is fairly complicated and is probably worthy of a presentation on its own. So, next slide. So you'll often have parties ask you, well, which type of deal is better? And frankly, it's a matter of perspective based on the specific circumstances of the transaction. The choice of form to be used in any given instance is a threshold issue that is determined through the negotiation between a buyer and seller, and typically involves significant input from the party's tax advisors. There are advantages and disadvantages for the buyer and seller in each type of transaction, and frankly, they're often conflicting. As you can imagine, this greatly impacts the purchase price as part of the negotiation. So from a buyer's perspective, they tend to prefer asset sales for two main reasons. One, generally they are more favorable from a tax perspective, primarily due to the fact that you're acquiring capital assets with depreciable capital cost. And from a liability perspective, you are only assuming the liabilities you know of and have expressly agreed to assume, in contrast to a share purchase where you are acquiring all of the assets and liabilities of the target corporation. So while a buyer can mitigate risk in share deals by obtaining proper reps, warranties, and indemnities, and perhaps represent rep and warranty insurance, which I think Travis will touch on later, indemnities are only as strong as the financial circumstances of the indemnifier and often have limited survival periods attached to them. In general, asset deals simply offer a greater degree of certainty to the purchaser and by extension the lender by minimizing assumption of risk in first instance, as opposed to having to pursue an indemnity claim on a reactive basis in order to be made whole in respect of losses attributable to a breach of or misrepresentation by a seller. Sellers, on the other hand, are generally going to prefer share transactions for a number of reasons. First, selling shares frees the seller of any liabilities that have been disclosed in the purchase agreement and on the balance sheet of the business, as well as contingent liabilities which remain with the corporation after the sale. From a tax perspective, the sale of shares generally give rise to capital gains, half of which are then taxed, resulting in an effective tax rate of 1/2 the rate applicable to ordinary income. And also on this point, for qualifying small business corporations, shareholders will have likely positioned themselves to take advantage of the lifetime capital gains exemption in Canada, which currently sits at $919,630 per individual, and this is indexed annually. So if you can imagine a generational family-owned business with 2 parents, 2 adult children, and 2 spouses, if structured properly, that could mean nearly $3 million in potentially tax-exempt capital gains for that specific family. So you can appreciate why structuring the deal is an important aspect of it. And as a brief aside, that this isn't planning you can do at the last minute. If you're a seller, in order to properly structure yourselves to ensure you're eligible for this, you need to look at this at least 2 years in advance, because there are some rules in place there that require the structure to be in place for 2 years prior to being able to rely on the exemption. The tax implications of a sale of assets, on the other hand, are going to depend on the tax position of the corporation prior to the sale, allocation of the purchase price among the assets being sold, and how and when the proceeds of the sale are paid out by the corporation to its shareholders. In allocating the purchase price, the buyer will prefer to allocate as much of the purchase price as possible to inventory or depreciable property in order to minimize future taxable income. The seller, on the other hand, is going to want to ensure that the allocation of the purchase price minimizes recapture on any capital cost allowance previously deducted on depreciable property or a realization of income on the sale of inventory. So in deciding upon a structure, the parties also need to consider that an asset transactions are generally more complex than a share transaction, since they require the parties to obtain a larger number of consents and transfers to transfer from a larger number of diverse assets. However, on the share side, the additional due diligence required for a share transaction, which Travis will touch on shortly, may impose longer pre-acquisition time frames. So next slide. So with all that said, I think from a lender's perspective, regardless of whether a borrower is acquiring shares or assets, the key issues to address are generally the same. in order to structure financing for a transaction, we just want to ensure that following closing, that the lender has appropriate security over the assets of the business, which necessitates a clear understanding of the post-closing corporate and asset ownership structure. 2, we want to ensure that appropriate guarantees and postponements have been obtained from all necessary parties based on the post-closing structure of the business. And 3, that the purchaser has prudently structured the transaction to ensure it has proper recourse against not just the vendor, but the vendor's kind of beneficial owners, so as to ensure that there are persons and assets to pursue in the event of a material breach or default in relation to the transaction. So thank you. I'll now hand things over to Travis, who's going to be taking you through the due diligence closing processes for customary share and asset purchase transactions.
Thanks, Sasha. I'll just wait for the slides to change. So as Richard said, my name is Travis Evans. I'm an associate with Gowlings I work out of our Hamilton office. I work primarily with corporate transactions, both share and purchase transactions, share and asset transactions, and also commercial lending. So whereas Sasha spoke to financing acquisitions, generally I'll be speaking to some of the finer points of the transaction relating to due diligence and closing. So I understand the majority of the participants in this conference are bankers or involved with lenders of some kind. So as bankers, you won't be as intimately involved in the due diligence and closing process, but understanding how a purchase transaction works from as between the seller and the buyer from start to finish is important to understand. Your counsel will work with your borrower, / the purchaser's counsel, particularly with respect to due diligence. And understanding that process can help you better understand your counsel's advice and allow you to make more informed decisions based on that advice. So, with respect to due diligence, so as Sasha discussed, in a share purchase transaction, the buyer is purchasing all or a majority of the issued and outstanding shares of the target company from its shareholders, the sellers. So an asset sale involves the negotiated purchase of specified assets, and in many cases, the assumption of certain specified liabilities, without actually acquiring the entity that owns them. So the due diligence involved in each transaction will differ, but fundamentally the process is the same in each case. And at a high level, due diligence is the process undertaken by the buyer to familiarize itself with the business and assets of the seller or the target. The scope of the due diligence generally varies depending on the nature of the business acquired, of course, the industry in which that business operates, and a bunch of other legal and business considerations. In addition, the nature of the due diligence is dictated by the structure of the acquisition, as Sasha mentioned. Asset transactions are generally more complex than share transactions. They require the parties to obtain a larger number of consents and to transfer a larger number of debts. But share transactions generally require more due diligence since the buyer is purchasing a company and all of its operations, all of its assets, all of its liabilities. So in a share transaction, the legal due diligence typically involves a number of things. So first and foremost, a review of the corporate records of the target corporation, a review of any contract or agreement to which that party, and if there's many, if it's a large and complex business and there's a ton of contracts, there might be a threshold placed on that in terms of what the buyer's counsel is looking at. They'll skip over more trivial documents. You'll also run public searches in connection with the corporate status of the target company, encumbrances registered against it, and litigation. And we'll talk about that in a bit more detail in a bit. You'll review the target company's intellectual property, and the importance of that will obviously depend on how material the IP is to the acquired. You'll review certain government records relating to the target company. Some of those can only be accessed with the target company's written consent, tax records, employment records, environmental records, and so forth. And then there's any number of other diligence matters that would be dictated by the nature of the target company's business. And the corporate records in particular should be reviewed to verify the number and type of issued shares of the target company, to compare those, of course, against what the buyer thinks it's buying in terms of the outstanding share capital of the target. So a review of those records, in particular the board of directors minutes, can also provide valuable insight into the target company's business. It may help uncover potential liabilities that can be addressed prior to closing of the acquisition. So legal due diligence in an asset transaction is generally the same, although it's of course focused on matters that are related to the assets or liabilities that are actually being acquired or assumed. And then non-legal due diligence will be conducted by the buyer itself and by their other advisors, accounting and tax and so forth, on financial, operational, administrative, and tax and accounting matters. And those are all undertaken in the context of any kind of acquisition. So I wanted to talk a little bit specifically about the difference between real property due diligence and personal property due diligence. From the buyer's perspective, there's, of course, going to be many different aspects of their diligence process relating to the acquisition of real property, the condition of the assets, suitability for their ongoing operations, and so on. And that'll factor into their decision to complete the acquisition or not. From a legal perspective and from the banker's perspective, the main consideration is ensuring the property is being purchased free and clear of any liens or other encumbrances. So due diligence relating to real property, and when I say that, I mean land and buildings and real estate, it's a bit more nuanced than due diligence relating to personal property. With real property, the buyer's counsel will need to look at title and not only identify, of course, whether there's any mortgages or other liens that need to be discharged, but whether there's any other registrations that just give rise to concern, like easements or notice of leases, restrictions on how the property can be used or how it can be developed in the future. It's also important for the buyer's counsel to conduct environmental due diligence to ensure that liability for any environmental cleanup is not assumed by the buyer in connection with the acquisition. Environmental liability typically flows with ownership rather than staying with the party that caused the environmental issue. And so mortgages and liens can be addressed through conditions in the purchase agreement requiring the seller to discharge those. Environmental risk is typically mitigated through representations and warranties in the purchase agreement, and the indemnities related to breach of those reps and warranties. And if the buyer has particular concerns, or if the nature of the business as it's conducted makes it likely that there would be environmental issues, the buyer may conduct environmental assessments prior to closing and seek specific indemnities for those issues that are uncovered, or a reduction in the purchase price that's commensurate with the environmental risk that was identified. So with respect to personal property, the buyer's counsel and your counsel will conduct searches under the Personal Property Security Act registry. Differs a little bit in each province, but across the board, it functions as a notice system to other secured creditors of a creditor's security interest over particular asset. So if other security interests are identified, the seller will typically be required to discharge them, or at least obtain a letter from the secured party confirming that they do not claim an interest in the assets that are being acquired. And PBSA searches are not only relevant to asset purchases, but they're relevant to share purchases as well. I'm sure you all know security interests can extend to intangible assets such as shares. So to the extent the PPSA search reveals an all assets registration or some kind of registration that's ambiguous and you can't tie it to a particular asset, it is common practice for a buyer's lawyer to insist upon a letter from the secured party confirming that they don't claim an interest in the shares being purchased. So I'll talk a little bit about representations and warranties in particular. Sasha had touched on these generally. So reps and warranties are one of the main components of the purchase agreement, and they're the equivalent of kicking the tires and checking for rust on a used car you might want to buy. Through the reps and warranties, the seller is making a number of factual statements about the assets being purchased, or in the context of a sale, about the business itself. In the context of an asset sale, the reps and warranties will obviously be limited to the specific assets or liabilities being assumed. And so for that reason, they can be less extensive than the reps and warranties in connection with a share sale. But for a share sale, the buyer needs the seller to make representations and warranties about the business being purchased. And those are often in pretty agonizing detail and, as you can imagine, the subject of a good deal of negotiation. Because outside of the physical inspection or assessment of hard assets, it's really the only way for the buyer to understand what they're buying when they're buying a business going concern. So those reps in a share sale typically cover a number of things: share capitalization, tax matters, employees, real estate, personal property, contracts, suppliers, and customers. And of course, the content of the reps and warranties will depend on the nature of the business. You won't need reps and warranties on real estate if it doesn't own any real estate, for example. And so just generally speaking, the reps and warranties are tied directly to the indemnity provisions. The indemnity provisions are often negotiated to include a number of specific issues that have been identified in the due diligence process, but the seller will always be required to indemnify the buyer for a breach of the reps and warranties, subject to negotiation about the extent of that liability and limitations on the length of that liability. With reps and warranties, we'll talk about how disclosures work. So attached to the purchase agreement, there'll be a number of schedules tied to individual representations. So those schedules are typically referred to as the disclosure schedule or disclosure letter. And that's where the seller has the opportunity to disclose or provide information relating to the assets of the company being purchased. And they would serve to qualify the various reps and warranties being provided. So for example, the purchase agreement might say that except as set out in Schedule XYZ, the company does not own any real property. And in the schedule would be where the real property would be listed. So for example, in those schedules, the seller will be required to disclose the outstanding share capital. So you can compare that against what the buyer thinks they're buying. Significant contracts with third parties, from your perspective, contracts with other lenders, security agreements, agreements where the target company has agreed to guarantee the obligations of another entity, list of employees, liens on assets that the seller proposes not to discharge prior to closing. So pay attention to those. Consents required under contracts or permits that would need to be obtained prior to closing. Bank accounts maintained by the target, permits required to operate the business, and then, sometimes a list of real estate or material personal property assets. So you should pay particular attention to these schedules, and you should ensure your counsel reviews them and identifies any matters of concern. So for example, the buyer and seller may agree that a particular lien on an asset will be assumed by the buyer. Maybe that's acceptable to the buyer, but probably not acceptable to the lender. If there are a number of consents required from third parties or regulators before the sale, the banker will want to pay attention to those and obtain confirmation that they've been satisfied and in particular not waived by the buyer, as is their right under the purchase agreement. Make sure those are satisfied before the acquisition facility is advanced. And while most share sales are completed on a debt-free basis, the buyer might agree to assume certain debts of the target company or even assume credit facilities maintained by the target company if it makes sense for them. That's obviously of concern to a lender advancing acquisition funds and taking security over the target's assets. So, still on this slide, insurance. So it's becoming increasingly common, although I wouldn't say it's commonplace, for the buyer to obtain representation and warranty insurance, and that would cover breaches of reps and warranties in the purchase agreement. It's a fairly new product that's being offered by insurers in the last 10 years or so, but it is becoming fairly popular. From a buyer's perspective, rep and warranty insurance is attractive since the buyer only has to make a claim under the policy if a loss is suffered, rather than chasing the seller to fulfill its indemnity obligations. And as Sasha mentioned, an indemnity is only as good as the financial condition of the party providing it. So from a seller's perspective, having the insurance in place, significantly reduces the seller's liability exposure under the purchase agreement if there is a breach. And it also has this indirect effect of allowing sellers to accept more robust reps and warranties under the agreement, because there's less liability exposure if something turns out to be false. And from a lender's perspective, just be aware that rep and warranty insurance, the process of it can be time consuming and could result in closing delays. And in most cases, the insurer will want to retain their own counsel. That counsel will conduct their own in-depth due diligence of the target company along with the buyer's counsel, or their work in conjunction, so that the insurer can actually underwrite the risk. So with rep and warranty insurance, from your perspective, a couple things. Stay apprised of the issues identified by the insurer's counsel. Ask the question, obviously, if insurance is being obtained. The actual policy is typically delivered near the end of the transaction once the insurer's counsel has completed their due diligence. So make sure you have enough time to review the policy with your counsel and identify problematic gaps in coverage if there's any. And consider whether the bank wants to obtain an assignment of the policy. For example, if the bank is already taking an assignment of the purchase agreement as collateral security, the insurance policy is also critical to the transaction. And then another just quick point about insurance. Of course, ensure your borrower has arranged for appropriate insurance coverage for the assets or the business being acquired, particularly if the bank is obtaining security over the assets being purchased. And so, throwing a lot of information about due diligence at you. So just from your perspective, again, you're not going to be involved intimately with due diligence and the closing process, but just a few things to keep in mind, to take away anyway. Number one, don't rely exclusively on the representations and warranties in the purchase agreement. Instruct your counsel to perform their own due diligence whenever possible, and at a minimum, searches of public registries to identify liens and other issues. Review the reps and warranties in the purchase agreement, but again, don't rely on them exclusively. Review the disclosure schedules in the purchase agreement and have your counsel identify anything that should be of concern to you. And then identify and communicate the conditions that the bank wants to impose on the closing of the purchase transaction, if any. So, for example, discharges of any liens, comfort letters that need to be provided, consents from third parties or regulators, and if you require an assignment of the purchase agreement, of course, make that a condition of closing. So next slide, please. So we'll talk a little bit about closing matters now. The closing process is fairly similar, whether the acquisition is of specific assets or shares. At its most basic level, the parties will prepare and exchange a number of documents in order to effectively convey the assets or shares and authorize the transaction from a corporate perspective. There's going to be a bit more paper for an asset transaction. So like we said, there's specific conveyances that might be needed for, depending on how diverse the assets are that are being purchased. So from your perspective, as bankers, the primary concern is identifying conditions for closing that are of concern to the bank, such as consents and discharges, and ensuring those conditions are met and not waived by the parties. Keep in mind that the bank is not a party to the purchase agreement and has only an indirect interest in its terms and outcome. So the bank needs to impose certain terms where necessary as conditions to the acquisition financing. Those conditions should be included in the purchase agreement between the buyer and seller, and ideally should be included directly in your credit agreement to the extent your processes allow for that type of detail in your credit documents. Best practice is also for your counsel to obtain a certification from the borrower, confirming that all of the identified conditions to the closing and the acquisition have been met, and again, in particular, that they haven't been waived by the buyer or the seller, and that all required discharges have been obtained. And just quickly on, some common, pre and post closing, let's call them reorganizations or steps that are taken, and then security considerations that you'll want to take into account. So the buyer will often incorporate a new corporation to purchase and hold the assets and either amalgamate that purchaser corporation with an existing company in its group, or in the context of a share sale with the target company that it's buying. So they may amalgamate, they may not. Those decisions are often driven by tax and accounting considerations, but are also often undertaken to ensure, liability under the purchase agreement and any potential liabilities relating to the assets that are being purchased are not rolled into an existing operating company. And from your perspective, your main consideration should be ensuring you have obtained adequate security both pre and post closing and pre and post amalgamation. And so you should consider a couple things. Any security required from the purchasing corporation, so that new corporation that's being purchased or incorporated rather to complete the purchase, keeping in mind that the only asset of that company is likely to be the purchase agreement itself until the closing takes place. Number two, ensure the bank has sufficient security both pre and post closing and pre and post amalgamation, if that's applicable. So in the context of a share sale, the bank should consider whether it requires security from the target company pre-closing. And by that, I'm talking about the company that is yet to be acquired by your customer, and whether any refreshed post-closing and taken from the amalgamated entity, if that's applicable. And so if an amalgamation takes place, keep in mind that though the predecessor corporations do not technically cease to exist, they do continue on as an amalgamated corporation, from which the bank should also obtain security if that's required by your credit group. So that's it for me. I've thrown a bunch of information at you very quickly. So kind of intentional. Please, if you have any questions, we left some time at the end of this for people to ask questions. So feel free.
Okay. Thanks very much, Travis and Sasha. That's very helpful. I do see that there is one question that we have already, but I do encourage everyone to post some additional questions that they might have. Otherwise, there's a real chance that Sasha might do a full rendition of one of those songs that he's listed in his slides, and that may be the Spice Girls tune. And so I don't know if we're up for that. The first question is, if in an asset purchase, can the buyer continue using the seller's company name? If yes, what are the implications?
It's good. It's a really good question. The simple answer is yes, although we want to make appropriate provisions for it. And the real question is, I guess, if the company's name is part of the brand and the goodwill, then obviously the buyer will want to keep using it. What we'll often see is the buyer will acquire the right, and instead of modifying its own corporate name, it'll register the business name and operate under that name. However, at the same time, we always want to make adequate provisions for that seller to ensure that it undertakes to change its corporate name. So you'll often have an undertaking and closing where a seller will file articles of amendment to change the corporate name, often to a number company, just to cease using that brand going forward. But the buyer will definitely want to acquire it if it's part of the brand and the goodwill associated with the business. And that's the traditional mechanism for doing it in an asset deal.
Okay, great. I think our next question is, if an amalgamation of a borrower occurs after closing, is there something that the lender should do to research or re-perfect security? In terms of,
Travis, that kind of ties to what you were speaking there. I don't know if you want to just speak to that.
Yeah, sure. So just make sure you're understanding what is contemplated pre or post closing in terms of incorporating new entities or amalgamating existing ones. So yeah, I mean, consider that post closing you'll have a new entity you're dealing with that is, potentially your borrower or be a guarantor or something. So just consider whether you require taking all the same security from that amalgamated entity as the purchasing company.
And maybe it's just important to add also that the amalgamated entity, it's not relieved of any obligations or liability from its predecessor corps. Those run with the new entity, but to the extent the names have changed and, in terms of ensuring that your security documents and your registrations have the new corporate name in order to, provide, notice to the world of your security, it is prudent to take those additional steps. But that by virtue of amalgamating, it is not relieving of itself of its obligations to the lender. So I think that's an important point just to keep in mind.
And one other item that's involved there is that we often will take something called an amalgamation confirmation of security agreement, which serves to basically list all of the security that was granted by the pre-amalgamation entities, and then have the new amalgamated entity confirm its obligations under all of those documents. And that often comes up with the purchase agreement, or not the purchase agreement, but the credit agreement, because in many cases, the credit agreement is done far in advance of the closing of the transaction. And that credit agreement might, if it's done in a letter format, might be addressed to the borrower as it existed at that time. And then it's subsequently been amalgamated. And so having that amalgamation confirmation of security agreement just helps to pull together everything in one package that we can point to as being evidence of the continuing obligations of the amalgamated corporation as the continuing borrower under the credit agreement. In terms of other questions, I guess that's the only ones we have in the box right now. But
I'm seeing a bunch, Richard. I don't know if
are they coming up? Okay.
Yeah. Sorry,
I didn't see them. Okay. Sorry. Down here. So we've got, can you speak to the information you need to provide a quote on the cost of a share purchase transaction or asset purchase transaction? How accurate can the quote be at the outset?
We've actually, fortunately, we have especially for more complicated deals, we have some internal tools that we can utilize. It's a pretty broad questionnaire in terms of the information that we would obtain. It varies whether or not you're acting for the buyer and seller. Often the purchaser's lawyer is gonna take the pen on these agreements. So if you're selling, you're going to be more in the reactive position, whereas if you're the buyer, your lawyer is the one that's going to be taking the lead on drafting the documents. And really, I think the most important information we need to have on the outset is what kind of corporate structure are we dealing with? What's the nature of the business, and most importantly, what kind of third parties are going to be involved in terms of getting consents and other information from. That is really what drives, I think, the transaction costs up, is having to deal with third parties, getting consents, getting releases, and then to the extent, the other key aspect is, how much back and forth is there going to be between purchasers and sellers counsel in order to conclude an agreement. So, like I said, we've got some good internal processes for providing you with quotes. They are obviously going to be based on a number of assumptions, and they are going to have to account for the possibility of the transaction changing. But we can give you a fairly good understanding of what the fees will look like at the outset of either deal.
Okay, great. I think our next question is, can you speak in more detail about security considerations for the target in terms of what might be required pre and post acquisition?
So I can probably answer that. I think it kind of depends on what your credit requirements are in terms of the specific security you might need. Presumably from the target, you'd be taking the general security agreement effective on the closing date, and then if there's an amalgamation after that from the Amalco as well. If there's specific assets you require security over, IP or real estate, then be sure you're taking that from the target, both on the closing dates and post closing if there's some kind of amalgamation or reorg after that.
The one point I might add to that is just that when you're looking at taking any kind of security from the target before the acquisition is completed, you have to understand that the existing owners of the target are not going to allow that security to be granted until basically the money for the acquisition is being funded. So whatever security that you take, the actual documents won't become effective until they can be signed by the new owners of the business or the assets. And that happens, sort of almost simultaneously with the funding. So it's pretty much a step transaction, so that as soon as all the documents are in place and they're going to become effective in a series of steps, and as soon as the funding is provided, then all the steps, fall into effect as like a domino, and you eventually have the security from the target that you need to have. I guess our next question is, if a buyer purchases a company through an Amalco and the bank funds to the Amalco, is it reasonable for the buyer to hold off on amalgamation for a few weeks for tax purposes?
So again, as noted at the outset, we're not tax experts, but from my understanding, I don't know what those tax reasons would be, because I think the thing that strikes me and the concern I would have and would go to an accountant right away to ask is, we normally do the amalgamation is a post-closing event that occurs almost immediately after closing. And I think the real benefit of that, as I understand it, is to avoid, multiple deemed year ends. You're going to have a deemed year end on the change of control, and I suspect you're going to have another potential deemed year end upon the amalgamation taking place. So I think from a tax administrative perspective, you would do it. Now that being said, there's no reason why, from a corporate law perspective, you need to amalgamate right away. But you're just going to want to ensure that in terms of how the kind of security is structured, that it contemplates and is prepared for that through the process. I mean, the reason buyers use acquisition companies, especially on share deals, and then follow it with an amalgamation with the target is really driven by the desire to have the expenses incurred in relation to the financing, whether it be at closing and the ongoing interest expenses. You want those to be in the hands of the operating company to ensure deductibility against revenue. So that's why the lender is going to advance funds to the entity buying the target. but then immediately following acquisition, they amalgamate. And as I mentioned earlier, obligations and liabilities run with the Amalco, meaning that all of those financing obligations are now in the hands of the Amalco. But just to briefly return to the question, I'm not sure what the tax purposes would be. I suspect functionally you could do that, but I think it generally makes more sense to do it contemporaneously in terms of 1 second after closing, you file the articles of amalgamation and you get it amalgamated.
Okay. The next question is Alex Ross noted in the earlier presentation to ensure the security agreement captured the goodwill associated with perfecting an interest in IP. Are the lender's standard GSAs capturing goodwill assets created in a purchase and sale? In terms of that particular goodwill, I mean, every lender's GSA is a bit different. But one thing I think that's consistent in all of them is that it does usually say that it extends to all assets of every nature and kind, and present and future, and it's usually stated as broadly as possible, and then it will list specific types of assets. And so the description of intellectual property may individually cover the goodwill in terms of its expressed terms, but if it doesn't, then there's also the ability to look at that general granting of a security interest clause that would cover not just the IP, but also the goodwill that was associated with it as a general asset of the company. In terms of our next question, in a share transaction as counsel for the lender, are there any unique considerations we should make when dealing with the assumption of warranty obligations if the GSA covers the product subject to warranty?
So if I'm understanding correctly, we're talking about actually warranty claims that third parties may have who have purchased the product. At least that's
I
not
took it to mean
or
financing a piece of equipment that has a warranty attached to it. I'm not sure.
Well, let's consider it from both perspectives. I think if we're talking about warranty claims tied to product that's been bought and sold, that is it. If it rests with the company or if it rests with the purchaser, that's just an additional liability to be mindful in terms of your risk, the risk profile and potential third-party claims against the assets. So you just want to make sure that from a lender's perspective that you have the security and are going to have priority over any such claims over those assets. Travis, I don't know if you want to speak to it from your perspective.
Yeah, I think it's kind of an interesting question. So if you were financing the acquisition of, I'm thinking of like maybe a multi-million-dollar piece of mining equipment or something that's critical to the business and it has a warranty from the manufacturer, certainly you would want to ensure that product continues to work from a lender's perspective to generate revenue for the business. So it's a pretty unique question. Maybe you might want something in your credit documents, a covenant requiring your borrower to pursue any remedies it has under the warranty, for example. It would want to do that anyway, so it's probably not a huge concern. But that's an interesting question.
And I suspect, and the other question to consider is whether or not that product is owned or leased. And maybe Richard, you could probably speak to this better than we can, but if we're talking about lease products in particular, I would assume there is language or in any kind of assignment of leases that's been taken as part of the security package that would ensure that the lender has the benefit of any of these warranties.
Yeah, usually in any kind of assignment of leases, the definition of leases would be broadly stated to basically cover any kind of assets that are linked to the leases themselves. So although every document is different, generally there would be coverage through that sort of avenue. Our next question is, can you please clarify if two numbered companies be amalgamated, as I believe this was an issue I faced leading into closing?
Well, I think it's similar to what we touched on earlier. If two numbered companies amalgamate, unless you're selecting a corporate name on the amalgamation, they'll be amalgamated under a new numbered company. It's a new legal entity. It'll have its own Ontario corporation number, assuming it's Ontario. But much the same way, you want to ensure that any of the security that references the two amalgamated entities previously is covered through any of that post-closing documentation that both Travis and Richard touched on earlier.
Okay. Next question is, are there any special considerations in terms of process or security when our borrower tells us that the transaction needs to be a sign and close?
From a corporate law perspective, sign and closes are pretty standard. Richard, I don't know. I mean, I guess if a credit agreement is signed, there's going to be conditions tied to the agreement to the transaction closing. But I'm not sure if, from my perspective, this changes much. But maybe as a lending lawyer, you might have some insights into that.
Yeah, with that, it's really, in many cases, the credit agreement is signed up in advance if it's prepared directly by the lender. In situations where it's prepared by counsel, it's normally another sign and close situation. If it is prepared and signed in advance, then normally we would, as part of the closing documentation, there would be a what we call a bring down certificate where any reps and warranties and any of the documents that were signed previously are brought down to the actual day of closing. So there's no gap in terms of the time between certain events that may be problematic can occur. So everything gets brought down to the closing date. And so there's no gap in terms of the reps and warranties. Okay, so our next question is, in a share purchase agreement, how long can a contract protecting the purchaser from all liabilities in the transaction stand?
This is really getting into, I guess, survival periods. And so you'll often have indemnification provisions that have corresponding survival periods tied to them. If you're the seller, you want the survival period to be as short as possible. If you want the buyer, if you're the buyer, you want them to go on in perpetuity. And where you're going to land is somewhere in between. What you'll often see is a basic survival period of let's say anywhere from 2 to 3 years for kind of the basic reps and warranties. However, you'll also then have subsequent carve-outs. So for example, if there's reps and warranties tied to taxes, those will usually survive for as long as a period as the CRA or any other government authority can actually come after you for that potential breach, usually somewhere around 7 years, 8 years. And then if you're talking about a rep and warranty tied to actual title to shares, in my perspective, that should just survive perpetually. So you'll usually end up with some kind of mishmash of survival periods depending on the nature of the rep and warranty. I think the most important one, and that usually takes the most bit of time to debate, is that basic rep and warranty. I know people often jump to 2 years because in Ontario, at least, we have that standard kind of 2-year limitation period. I personally prefer to see at least 2.5 up to 3 years because I like to ensure that there is some period left available for discovery of potential claims and not just a 2-year basic limitation period on its own. So that's a negotiating point that usually doesn't come up until the lawyers get involved, but that's usually how you'll see it played out.
Okay. And our final question here is, can you discuss some circumstances for escrow agreements to be required and the standard timelines for release?
I can take this one. So you normally see holdbacks put into escrow on larger, more complex transactions, or where there's a decent chance of some liability arising post-closing, tax related or otherwise. So you might, typically how it works is you would have 2 separate escrow amounts. One is your working capital escrow amount set aside to satisfy any purchase price adjustments taking place post-closing, and the other is set aside to satisfy any indemnity claims for breach of reps, tax liabilities, or anything else that's in your indemnity provision. From a purchaser's perspective, you want those funds to be held back for as long as your survival period of the related reps and warranties and indemnities. Sometimes I see it being held for less time, and that's just part of a negotiation. Maybe the purchaser is satisfied that it's unlikely they'll make a claim after the first year, kind of thing, so the funds can be released. The process for that, so you'll have a separate escrow agreement between the parties. They can be complex or fairly simple in that they usually just provide for the escrow agent acting as an intermediary. The parties need to give joint instructions to the escrow agent before they can release any funds, and the mechanism by which the purchaser can make a claim, for example, will be set out in your share purchase agreement, and the mechanism by which the working capital or other purchase price adjustment will be completed will be set out in your purchase agreement as well. And then once that's settled, the parties will send joint instructions to the escrow agent to release whatever funds they've agreed can be released to the purchaser or to the buyer or to the seller. Sorry.
Okay. In terms of, I guess, one other, I think, important item that comes up is, in some cases when we do financings, we run into a borrower's counsel who have said that, they haven't done any searches. They're just relying on the reps and warranties of the vendor, and so that they don't want to deal with any third parties, and they're content with that situation. Travis, what would you do as a lending lawyer to address that particular set of circumstances?
I mean, it kind of depends on the transaction value and complexity, I guess, but in almost all cases, you would want to insist on the lender's counsel running their own searches. They're public registry searches. They're fairly cheap to complete, and through those searches, you can identify, liens and things that are really material to the lender. So the potential consequences of not running them are pretty significant relative to the cost of completing those searches. And then, you can do at least a basic level of due diligence by reviewing the purchase agreement and the disclosure schedules. Relying entirely on the representations and warranties, you're sort of rolling the dice because, those reps and warranties could be untrue, and then the purchaser has to go after the seller for a breach of contract or through the indemnity provisions of the agreement. So that's time consuming, it's costly. The lender's counsel should be doing their own due diligence to the extent it's feasible.
Yes, and I think one other added element is, as lenders, as your lawyers, we need your support in, I guess, pushing back on borrowers who are looking to just rely on those reps and warranties and want to forego approaching third parties for consents and things like that. It's just a very risky situation to avoid dealing with third parties, and you have to be prepared to push back a bit on your borrowers when they ask you to do that, because it's in your best interest to do so. I think we're running into the last minute of our presentation, so I'd like to thank Sasha and Travis for all the insight that they provided to us for this session. It's very helpful, and I hope that everyone has been able to get a few takeaways from the discussion. Coming up in the next minute is our next session, which is going to be on financing real property acquisitions. So I'd like to invite Stephanie Harvey, a partner in our Hamilton office as well, who will be the host for that session, to come up to the stage now. Thank you, everyone.